All right. Hey, everyone. Is anyone else cold in here? I'm freezing. Welcome. My name is Wendy Shao-Shattuck. I'm a partner at North Zone Ventures. We're a global venture capital fund that's been investing for over 26 years in European and US-based companies. I'm based in New York, and I flew in this morning. And I have the pleasure of introducing our next section, which will be about investor accountability. So this topic is near and dear to our hearts because we at North Zone are very excited about some of the technology that's been brought to society by some of the startups we've invested in today, such as Spotify, iZettle, Klarna, Trustpilot, Einride, and a host of others. But increasingly, these startups are also starting to have both positive and negative externalities on society because they're just reaching more people, and people are increasingly more connected. And so, in this era, we think that it's a really important time for investors to define their relationship in helping to shape and hold companies accountable to both the positive and the negative impact that they're creating today. So we'll hear from a number of experts on this topic today, both from the public side and the private side, and we'll also hear from some company builders that will talk about their experience working with investors. So first, we're going to have Lauren Taylor-Wolfe, the co-founder and managing partner of Impactive Capital, a leading impact activist investment fund, revamping the activism playbook by replacing confrontation with collaboration to put sustainability at the forefront. Join us on stage, Lauren. How are you doing?
I also dressed for the occasion.
So, Lauren, massive welcome. Those who are familiar with your work have referred to you as the Warren Buffett of impact activism. So I'm super excited to be able to chat with you on your perspective on investor accountability today. But why don't we start, for those of you who don't know your story, it would be great to hear a little bit about, from your perspective, how you came on this journey and how and why you founded Impactive.
Sure. Thanks, everyone, for being here. And despite the heat, I'm Lauren Taylor-Wolfe. I founded a firm called Impactive Capital. We are a $3 billion activist manager with a bent towards environmental, social, and governance change that drives value, long-term sustainable value. I've been an activist investor my entire career and realized really in the 2014, 15, 16 timeframe that the activist toolkit, which predominantly focused on capital allocation, so strategic initiatives, capital structure initiatives, and operational efficiencies, there was a toolkit that was missing one key tool, and that was environmental, social, and governance change that can link to long-term returns. And so we set out to pursue this in 2018 and launched the investment program in 2019 and have rapidly built the business. And we have a number of case studies to really substantiate that this strategy generates returns. A lot of people think that pursuing sustainability and impact requires some level of concessionary approach to returns, and that's absolutely not the case. In fact, we think it can be a key driver of long-term returns.
And your approach, it sounds like the perfect marriage between financial returns and impact returns, but could you crystallize that for us a little bit more in talking about maybe some of the recent wins where you've had using your approach?
Sure. The most important thing in, I invest predominantly in North America, where, capitalism, particularly in the US, comes first and foremost. And there's always been this approach to sort of shareholder primacy. And so the thing that we realize is that we have to link environmental and social and governance change or impact to quantified returns. And so the way we think about it and the way that we engage with boards and management teams is we think about impact investing affects really three key constituents. That's your employees, your shareholders, and your customers. And to the extent you can invest in a certain area, in a certain initiative, if you do it well, you'll attract and retain the stickiest customers, the stickiest employees, the stickiest shareholders. That lowers your customer acquisition cost, it lowers your human capital cost, and it lowers your overall cost of, financial costs, over cost of returns. And so our view was if we can demonstrate to companies how they can do that, they can drive, obviously, longer term, greater returns than their competitors. It makes them more competitive, it'll make them more profitable, and it'll make them more valuable. And so not only will you have changed that one company, you actually have the opportunity to impact entire industries. One big win that I know we've spoken about was Asbury Automotive. A lot of times management teams will tell us, how can diversity drive returns? Well, just a quick highlight here is Asbury, when we invested in it back in 2019, it was the 8th largest auto dealer. In the US, auto dealers are like locally protected monopolies. They generate 28 to 29% returns on invested capital throughout the cycle, peak to peak, trough to trough. And their best business is the aftermarket business, which is a parts and services business, right? That business grows mid to high single digits. It has 26% EBITDA margins, whereas the rest of the business, just selling new and used cars, has low single digit or mid single digit margins. We said to them, why are you only growing? If we take a step back and look at the industry, why are you growing your parts and services 7 or 8%? You should be growing at double digits. Today, cars are more silicon than steel. They have densely packed technologies into the auto body. And what we realized is that they were only utilizing their parts and services facility about 50%. Why? There's a huge labor shortage. There's a labor shortage throughout the entire industry. And when we got curious and we went to the Bureau of Labor Statistics in the US, that's the government entity that tracks how people's, what people go into which professions, we realized that they were overlooking a candidate pool entirely, and that's women. Women represent 2% of mechanics, but they dominate the industry for auto sales and retailers, spending over $200 billion. And so we went to the company and we said, you should really invest in paid maternity leave. You should invest in women's bathrooms. That's like a no-brainer to attract and retain women as employees in the parts and services facility. You should go to a 4-day work week and maybe do two shifts per the days. That allows for childcare and elder care, which are two things in the US at least that fall disproportionately on the shoulder of women. And so they made that investment. They're the only publicly listed auto dealer to offer paid maternity leave, and they've more than doubled their count of female auto mechanics. Now, why does that help? Well, again, we come to the table and we quantify the impact of all these initiatives. Well, if you can take your utilization in your parts and services facility from 50 to 55%, just 10%, because you're attracting and retaining more technicians, you will grow, because of the flow-through margins are so high, you'll grow your overall enterprise value by about 15%. And so that's just an example of a recent win where focusing on diversity, equity, and inclusion actually drives the bottom line.
Isn't that amazing, investing in women's bathrooms?
Yeah, it's almost a no-brainer.
But the results are real. And so when you look at that specific case and others in your portfolio, how custom are the metrics for success? And how, can you generalize it up a level to say, X, Y, Z, we do this across all cases?
I think it's very difficult. The challenge is, and I'm sure you see this, there's like 15 different standards boards. There's SASB, there's CDP, there's TCFD, there's SDGs. Coming out of COP26, a number of these organizations decided to jointly create the ISSB, the International Sustainability Standards Board, to try to get some centralized approach to environmental, social, and governance considerations. The reality is these are just subjective to some extent. And so from our perspective, while we certainly focus on things like diversity, equity, inclusion, and companies pursuing profit while at the same time reducing their environmental impact, those are the two general themes. I think each of the initiatives that we are coming to boards with, public company boards in the US with, are quite bespoke, right? We want to know, for each different company, we try to ask ourselves two questions. One, how can we solve a business problem with this idea or this initiative? And two, is it the idea that's going to drive the greatest order of impact profitability to the company?
Isn't the shade amazing?
I love the shade. The shade is really, really helpful.
So can you talk a little bit about your special sauce, which I think you brought over from the last fund you worked with, Blue Harbor? And what I mean by that is, while some activist investors go at it with a very kind of power-forward, leverage-driven approach, you guys try to work more collaboratively with the firms that you invest into.
Sure. So in the US, there's a very broad spectrum of activism, and many of the activists, from hostile to and adversarial to more collaborative. We are on the collaborative side of things in the US, and there's a couple of activists in France, actually, who I really respect. I think they call them les bonnes femmes. They're wonderful, but they really hold boards and CEOs accountable. In the US, the approach has always been really pursuing the proxy contest or embarrassing a CEO or a CFO or a board in the media. So we'll go to the Wall Street Journal or the Financial Times or the New York Times and say, here's why you suck. Enter CEO's name, and here are the 5 things that you've done, and it's terrible, and you've underperformed your peers. We wanted to flip that approach on its head. The ideas that we're coming to the table with are longer term in nature anyway, and so to the extent we could align ourselves with the CEOs and the boards and not embarrass them, we just thought we'd have an easier chance of executing over a shorter period of time. In the US, a proxy contest will cost tens of millions of dollars to hire proxy solicitors and PR, campaign and crisis management. And it also can take up to 2 years. Our view is let's stand shoulder to shoulder alongside a management team and a board and say, we're looking out over the next, call it 3 to 4 years, and we want to figure out how to make your company worth 2 to 3 or 4x, not 20 or 30% more. And that really resonates, right? We have great alignment. We're putting our money and our reputation where our mouth is. And if we can simply come to the table with our research and ideas, we're almost acting like a captive McKinsey or Bain. We can say, here's the ideas, here's what we're advocating, here's the research that substantiates it. It's very difficult for a board to be like, no, we don't want a great idea that's going to make our stock go up 2 or 3x. So our approach is far more collaborative, although I do appreciate and value, there is value to be created in the more hostile strategies, like the Carl Icahns and the Bill Ackmans of the world, but it's just not our view is let's save time and try to accelerate returns in a more collaborative fashion.
Right, and that really resonates also with kind of how we approach our position in private boards, which is, you definitely do see that dichotomy there as well, even for smaller companies. And as we're now entering a phase where retail investors are becoming more and more powerful and starting to, especially in the US, participate in more kind of cultural activism topics, and we'll hear from Troop later today talking about how they approach that from a consumer's angle. It would be really interesting to hear your perspective as an institutional investor, how you might work with or maybe not work with, or how you look at that movement in general.
I think the retail investor's voice has been given a microphone from a lot of the social media platforms like Twitter and even LinkedIn, right? So the retail investor, I think about that as the constituent of the customer and the employee. They have these tools available to shame companies and broadly advertise when they've been mistreated, and that's going to be valuable, but it's also quite distracting. If you're like a public company board trying to figure out what to focus on, you really need to understand where there's power in numbers. And I think I had a personal investment in a company, Say, which I think is pretty similar to Troop. I think what's going to happen is a lot of individual retail investors are going to start voting their dollars in a way, well, retail investors have 2 important assets, right? Their money and their time. And they're going to start voting both of those things in a way that aligns with their value system. And so we're already seeing this in the US. You have massive growth, right, in these ESG ETFs and ESG and impact-oriented public listed funds. Today, there's about $1 trillion of equity capital that's been raised there, and Larry Fink, who runs BlackRock, suggests that's going to about $7 trillion over the next 5 years alone. That's like a mid-20s compounded annual growth rate. And so I think where the retail investor is going to have a voice is going to be advising the passive guys like BlackRock, State Street, and Vanguard. These 3 entities basically wholesale all the ETFs and mutual funds in the US and really globally. And they're responsible for voting in a way that their constituents want them to vote. So today, those 3 entities own anywhere from 20 to 30% of every public company. They're going to have to listen to their retail shareholders' voices if they're loud enough, and I think they're going to start voting proxies in alignment with them. That will be extremely helpful because as the role of the shareholder, I think it's our responsibility to hold companies accountable. Companies say one thing here, and then they do something very different. And so we need to use the power of our voice and our vote to hold them accountable to making the changes that are required. For instance, many companies in the US have committed to reducing their carbon emissions 30, 40, 50% by 2030. We need to hold them accountable. What does that mean? What does that mean for you that you're doing today, right? You need to reduce it by at least 2, 3, 4, 5% in the next couple of years, each year. And so I think the retail voice is going to be extremely important for the passive investors to listen to, and the active investors like Impactive are going to be much louder and more annoying and directly in their face.
And that's really interesting. And what do you think across both of these segments, given the volatility in the market, and there will continue to always be volatility, how will you do long-term, like very long-term investing differently, and how do you kind of message that to all of your stakeholders?
Yeah. So one of the key differences, or one of the key changes that we made to our activist approach from both some of the activists that we observed in our field, but also our prior employer, was we really focus on, one, high-quality businesses, and two, we anchor to the long term. So we're looking out over a 3 to 4 year period. I've been around investing over 2 decades, and today, at least in the US markets, it's extremely volatile, and it pretty much only feels like the dot-com bubble, right? You have these massive momentum stocks like, Carvana or Stripe and Shopify, Airbnb, Marqeta, other, some fintech companies, but a lot of companies have gotten really penalized. Their stocks are down 70, 80%. For us, what we think is we're about to see massive layoffs throughout the industry in the US, because some of these companies were effectively, even with SPACs, I don't know if there's a lot of SPACs here, but there were SPACs which were blind pools of capital. And a lot of these companies were nothing but a PowerPoint presentation and a giant balance sheet. That's about to change in a big way, right? Companies are going into survival mode. They need to protect the cash on their balance sheet, understand their runway for livelihood. And so if we can organize ourselves, one, with cash to pounce in the public markets when there's an opportunity, but also, again, thinking about the long run, we have long locked capital. About 70% of our capital is locked in a 3 or 6 year share class. For us, it's going to be a great opportunity to pounce because we have companies that are publicly listed, trading at lower valuations than companies in the private market. We can develop a stake today and then really look out over the next couple of years about how we can help these companies execute a strategy so it's almost winner take all, as a lot of peers fall by the wayside because they haven't been judicious with spending and capital on their balance sheet.
And that just makes me think of something which we didn't get a chance to prep, so I'll ask you anyways. But on the private investing side, there's obviously sometimes disconnect in valuation, and but we also know that impacting ESG is a key concern for a lot of those companies, as our LPs are starting to hold VCs accountable and VCs holding companies more accountable, but more so than that, the founders themselves truly care, yes. Right? As a public investor, how do you see kind of the private markets bridging that gap into the public markets? Are you keeping an eye out for some of the trends that are happening already in the company building level?
Yeah, I think the younger generation, Gen Z and millennials, are going to have it right. They care deeply about the environment. My daughter is here today. She cares deeply about environmental conservation and animal rights. She's 9 years old. And throughout her entire age group, up to high school, if you poll them, what they care about is the environment. And so they're going to be building the companies of tomorrow that will vastly disintermediate the incumbent companies of today. So I see huge opportunities in the private market, especially these companies that have raised capital already, to be the leaders of change, the pioneers of change, to really make the difference. Because I think as the younger generation, Gen Z and millennials, as they come into more wealth and savings, they're going to, again, vote their dollars in a way that aligns with their value system, and that's going to drive, I think, massive sea change and shifts in the economics globally.
Thank you, Laura, and that's really, really insightful. Thank you so much. I've learned a lot hearing from you. And next, we're going to have a different group of investors and company builders talk about investor responsibility. The panel with Anne-Laurence Roucher from Mirova, Julie Davico-Pahin from Ombrea, and Dirk Meuleman from Phenix Capital, joining me on stage now.
Thanks, everyone.
Thank you, Lauren.
Good to be here.
I think we need one more chair. All right, now we continue. So this will be a really exciting panel because we have two very experienced investors who specifically seek to invest in impact-driven opportunities at an earlier stage. And then we also have one of their star portfolio companies to give a fuller perspective on how it's actually like to work with an investor with an impact agenda and how, to actually marry financial performance with impact. So it would be great, maybe starting with Dirk, if you could introduce yourself to the audience. And we'll just go down the line here, and then I'll go with questions.
Yeah, so my name is Dirk Meuleman, CEO of Phenix Capital. We're the leading impact investment consultant in Europe for institutional investors. So we work with pension funds, banks, insurance companies, sovereign wealth funds, helping them allocate more capital to good causes.
Hi, nice to meet you. Julie Davico-Pahin. I'm the co-founder and CEO of Ombrea, a startup based in Aix-en-Provence in France. We develop smart systems that modulate climate on the ground, and I think that could have been very, very, very useful today for us, because our job is to protect crops from climate change and drought especially. And we also work with Mirova, which is our main investor since 10 months, I think. 6 months? Yeah.
Hello, my name is Anne-Laurence Roucher. I'm Deputy CEO of Mirova. Mirova is an asset management firm 100% dedicated to sustainable investing. And on my side, more specifically, I'm in charge of private equity and natural capital investment activities. And so, yes, we have invested into Ombrea and will be happy to explain our interactions.
Hello? OK. Maybe we'll start with you, Dirk. Since you've been investing for over 15 years, and for half of that time with an impact lens, what are you seeing in the market in terms of the demand side of this?
So the demand side of this is just changing tremendously, because as society is changing, as there's more focus from beneficiaries of pension funds, more focus of clients of banks, of insurance companies, the amount of capital moving into the impact investment space is just increasing, and there's more and more demand every year. And the pandemic made us all realize we are more dependent on each other and has been a tremendous accelerator of this demand for impact investing. warm days like this also help, I can tell you.
And this is a question to you, Dirk, but also to the rest of the panel, if you want to chime in. So from your perspectives, is there still a trade-off, this kind of unanswered question between impact versus financial returns? For example, I think in the US, that is still somewhat considered separate. And there are impact firms that don't want to be associated with not driving financial returns, and then there are financially only focused firms that are looking to, get into impact but don't really know about formally defining themselves as such. So from your perspectives, how do you see this kind of more globally?
Yeah, so we used to, it differs how this is being viewed per country quite a bit. And in the US, this is still a question I get from our clients there. But in Europe, and especially in some of the places like the Netherlands, the institutional investors, the largest ones, they see this issue as solved. They see it as a driver of returns, because if you focus on high quality impact, if externalities are accounted for in the business plan, or if externalities are positive, that reduces the risks of your investments. During the pandemic, impact investing started a little bit over 10 years ago. At that time, we'd been in a long-term bull market. So there was this question in the market, how will impact investing, how will the performance, which had looked good the last 10 years, how will that do when there's a downturn? But we've seen the downturn with COVID, and impact investing has done tremendously well. It is asset light, so when oil went down, the prices were not as much affected. Big focus on healthcare, which we all know has been a great place to invest. So in Europe, I think this topic is seen as this has been solved, and impact's actually positive. And we have big pension funds, big asset managers that have also, and family offices, being very open about their performance and just showing, hey, our impact portfolio outperformed our traditional portfolio.
Great. And Anne-Laurence, so you have an investment thesis entirely based on sustainability. So can you talk a little bit about how you evaluate companies for that investment thesis?
Yes, that's a broad question. So I will take an example. Overall, what we seek to invest in is in projects or companies that really have impact at the heart of their investment and business model. So in the private equity space, we invest in corporates that will provide solutions, so technologies that are already proven with already existing revenues, which was the case for Ombrea, but who need capex to finance their development. And what we really look is that the business model has to be completely nurtured by impact. And I think Ombrea is a very good example, and it actually proves again what Dirk just said. Basically, we're going to look for companies like Ombrea. Ombrea is providing shading systems, shading panels, on which you have solar PV panels, so that provide renewable energy electricity, in addition to shade to crops, which enable to save water for the crops, on the irrigation, and also to improve the yields, in a nutshell. And so by doing that, by selling those solutions, of course, they have a positive impact, and also it generates growth, revenues, EBITDA, valuation. So for us, this is exactly what we are looking at. A company that have impact at the core of their business model, and impact will be nurturing their financial performance.
And am I correct in understanding you also help your company structure their roadmap in some ways?
Yes. So having said that, so we invest in environmental themes. I've explained that. So we'll look at companies which have investment, environmental transition at the heart of their business model in agri-agro technologies, natural resources, smart cities, renewable energy, circular economy. we will find this impact, this potential of value creation. But in addition to investing for just value creation, we will also build with the investee an impact business plan, which means that alongside the growth of the revenues, we know that some key impact metrics can be achieved, like the capacity of megawatts produced, the level of water that can be saved, the level of crop yield increase, and so on. And these are KPIs that we are in a capacity to build in full coordination and conjunction with the management of the investee to make sure that we'll track the financial business plan alongside the impact business plan. And I think maybe, Julie, it would be good to have your perspective on how actually we discuss that.
Yeah, of course. And why did we choose Mirova to come with us? We started our last roadshow last year in early 2021. We knew that we wanted to have a strong business expertise on energy, green energy, because as Anne-Laurence said, we can produce green energy based on our smart shade system. And also because our business model is based on impact, we wanted to be challenged on this way, on this subject. And that's why I can give you some numbers that can explain how we work on impact. We can reduce the needs of water by 20%, and we also increase yields by 30% on flowers, for example. So there are strong KPIs that we can work on with Mirova. And as you know, in France, especially because we raised our last fundraising were here, we met many impact VCs here. But we really wanted to have a strong impact fund in which impact could be a real strong policy. And that's what we found in Mirova, because we could meet a strong team dedicated to CSR, and we could be challenged, and the level is really good. And I think we almost worked on financial topics the same as impact topics all 6 months during the fundraising.
That's very interesting. I guess, you know, the board perspective as a VC is in the sort of the earlier days of building a company, and maybe even in earlier times, like the 90s or the early 2000s, where there weren't a lot of templates for how to do good board work, having experience and expertise in that subject, how to hire your CRO, how to XYZ, was really helpful, and was one of the core aspects of value add VCs brought to their companies back, especially in Silicon Valley when that kind of movement first started. But now, as startup knowledge has become really ubiquitous, you see venture funds starting to really reinvent themselves in terms of value add, providing capital sometimes as a commodity and sometimes using valuation to win deals, but also helping to source talent, connect to people in their operator network. But sustainability and kind of creating impact for with their companies together seems to be a new area, and a new area of competitive advantage even for non-impact driven VCs. But the topic which always comes under question is how much do founders actually want to listen to their investors and work together on shaping company goals, and how much of this relationship is more kind of advisory and just be it would be really great to hear from your perspective where you guys have learned from each other, and also where sometimes you're like, I have the best practices from my other companies, but maybe that's not so relevant to you, Julie, and sort of where that starts and ends.
We shared the same values, so it was quite easy to work together.
Yeah.
It was really simple. But I think it's because our business model is based on impact that was quite easy to put some KPIs in front of our financial goals. So it was very easy. I don't know, Anne-Laurence, if you want to add something, but I would like to share all the KPIs we are working on with Mirova, because that could give you very smart examples on what we were working on. I can give you a strong example on biodiversity. We were working, for example, on local crops that can be reintroduced in some areas in France, for example, almonds in Provence, and we could measure every KPIs on this activity, on this impact with Mirova, and it was quite interesting because all the KPIs we wrote on the roadmap was based on our financial roadmap covering 5 years period. So it was very determined by our business plans, and the non-financial roadmap was based on our business model roadmap. So it was quite easy with Mirova to just build it. And it was a collective work inside Ombrea. And I think that's quite interesting because we had a full dedicated team in Mirova that could work together with my team. And all my 45 employees are involved in this project. So wow. It's a very good tool to just have this strong cohesion in the team.
And from your perspective, how have you brought your expertise from your other portfolio companies to Julie's company, and then also vice versa?
So I think there are a couple of interesting elements. With regards to the CSR plan of Ombrea, so we mentioned the impact KPIs, which are truly fact-based, connected to the financial business plan. And then there are other softer elements, such as promoting diversity, becoming a mission-driven company, where actually, I think here Julie and the management team were looking for sparring partners to build really a CSR plan. And I think, at least Julie, you told me that what you liked is that you had experts at Mirova to discuss with, and also experts who were capable of telling you, don't go too fast, you won't manage to do too much in a row, so you need to sequence your plan. So that's one kind of added value we can bring. I think the second type of added value we can bring is connections, business connections. Yep. Because we are in the impact space, and typically shading systems, we have in our natural capital activities, we have sustainable land management investment strategies. We have agriculture projects in Northern Africa, where actually the systems, the shading systems of Ombrea could be sold. So it's, we can help make connections to increase your business. So I think there are many ways in which we can collaborate, both on the impact side and on the financial side for revenue growth.
And how do you create alignment, not just with the companies that you invest in, but also with your advisors, your own investors, and sort of the partners within the fund yourselves? And maybe, Dirk, since you haven't spoken for a while, it'd be great to hear your perspective on things like carried interest that's linked to, you know, key KPIs on the impact side. High level, how do you think, you know, that plays out in the industry?
Yeah, so the carried interest linked to impact KPIs is something we see more and more, and we track every case that we see. This is really a European phenomenon, and this is driven by the European Investment Fund that makes it mandatory for all their investments. So if you want to raise money with them, you need to align your carried interest to your impact KPIs. And their model is now, I think, in the last half year starting to become the dominant model. Before that, I'd seen all the different ones. There weren't two systems that looked anything close. Now the market seems to converge to this. And it's interesting to see how Europe is leading in this space because, in the US, I don't see it happen that much yet.
I agree with that. Do you guys have perspectives on this as well?
Yeah, sure. So, of course, we thought we need to really have an alignment between the investors, the fund manager, the corporate. So we discussed the link between the fund and the corporate, and then how do we align with the investors. So yes, we had to put impact as conditions to generate, to be able to get the carried interest. So we benchmarked a little bit the impact, the way impact was linked to carried. We try to, sometimes it's done in a light way, like you just have to check a minimum level and then you get all your carried. What we did is really connecting these impact KPIs that we discussed earlier. We have an impact business plan, which is highly linked to the financial business plan, which enables that we can make sure that all the investments we're going to make are tightly linked to impact. And the achievement of these impact KPIs is 50% correlated to our capacity to actually get the carried interest, which means we are twice correlated with the performance of the corporate financially and at impact level, so ultimately twice at carried interest level. And we think it's very clear. It then makes it compulsory to have an impact committee who will review the key performance indicators for impact. So we have set up an impact committee with 4 independent members, and then ultimately auditors who will check the accuracy of the KPIs. So I think the whole process is pretty simple conceptually. I think it means that probably we won't get 100% of the carried because we won't be perfect everywhere. We'll have companies which will perform a bit less, but that's the game, and we think it's the better way to be aligned, and we think it's probably the future.
Yeah. I would like to add something. It's a living roadmap, impact roadmap, because we readjust every year the KPIs and the goals. So it's quite interesting because every year we know that we are going to be challenged by Mirova, and we are going to be more specific on certain topics, and that's quite interesting for an entrepreneur to be challenged every year on this subject.
And how do you must feel pretty good that your investors are fully aligned with you as well financially? Yeah. Great. And so maybe the last question is, there's a lot of companies that have prioritized impact in CSR and a lot of funds that have, but there's also a lot that haven't. So what would you guys say, and this is a question to all of you, is the minimum one thing that investors should expect to see from their portfolio companies, even if impact isn't sort of their near-term metric that they're guiding themselves by?
I think the number one thing to see, does the company aim fundamentally to try to make the world a better place? I think fundamentally that's what impact comes down to. And then the secondary concerns are, okay, how do you measure it? If you measure it, how do you optimize it? How do you make the trade-offs between corporate decisions? Do we invest left or right? But in the end, is the company trying to make the world a better place? That's the starting point.
Yeah, I would add to that, as an investor, do I invest at the right time where the companies need most that capital? You can invest when it's easy, when the company is big enough and you have no additionality investing at that time. I think what makes sense is to really be here on the early days when you know the company has proven the concept but needs to accelerate. It's not when the company will be big enough with a solid track record that actually it's going to be easy to take a risk. So we invest rather in the early days, but within proven technology when the company needs to accelerate. And I think here we prove that we are intentional on the impact. We have additionality because of the timing of when we invest, and then we measure with the KPIs. And these 3 elements are the basic definition of what impact is.
And Julie?
And as an entrepreneur, I would advise to other CEOs to choose the right and a good one, good impact fund, because there are so many. You have to be sure that you will find in front of you a strong team that is going to challenge you on real KPIs, because sometimes on many funds we could discuss with, impact was just a greenwashing or green marketing policy. So you have to be very careful on that subject.
Great. Thank you guys so much for joining us today and showing us how investors and company builders can work together to align all the stakeholders in the value chain to drive impact. So next, we're going to have Félix Tabary, the co-founder and CEO of Troop, a consumer activist investing platform looking to bring more aligned retail investors into the mix, literally giving power back to the people. So thanks again. I'm just going to take a little tiny break. I'm just, yeah. Hello? Okay. So next, we have Félix Tabary, the co-founder and CEO of Troop, a consumer activist investing platform looking to bring more aligned retail investors into the mix. Welcome, Félix. Different up here, right?
It's toasty.
Great. So, Félix, as disclosure, Northzone and I, as a board member, am an investor in Félix's company, Troop, and I serve on the board. And so, I think sometimes these conversations are better when they're a little bit more organic and free-flowing as well, given I have a bit of experience with the company. But it would be nice, Félix, if you could start by telling the audience a little bit about your story, starting Troop, why you think it needs to exist in the world, and where you saw the opportunity.
Sure. Thanks, Wendy, and thanks first and foremost to the Northzone team and the rest of the Change Now organization for the opportunity. So Troop was born out of a little bit of inspiration, observing a moment that took place last year in January of 2021. We saw a very large group of retail investors coordinating a purchase of shares of GameStop, which is an organization that similar to Best Buy that sells video games online in brick and mortar stores. And the purpose was to coordinate a trade and then make sure that nobody sold their shares. And in an interesting kind of turn of events, the majority of retail shareholders showed up to actually vote their shares at the annual shareholder meeting. And having started my career at Bloomberg a number of years ago, and having spent a little bit of time kind of obsessively following the drama and the excitement of activist hedge funds, it kind of reminded me of what these people basically were doing, but in a collective, distributed kind of way. And along with a few friends, we decided to explore that idea, that concept. What would it look like if all of us here bought 1 or 2 or 3 shares of the same company and then decided to just sit on those shares and then leverage our collective ownership of these companies, or this single company, for the greater good, right? At the annual shareholder meeting, show up, make a proposal, and advocate for change.
And that is a really, promising vision. And there's certainly consumer sentiment there, as Lauren said earlier, expressed through social media and other platforms. But how do you turn that into a product? What consumer problem are you solving?
It's a great question, and I think mixing the concept of a product and a problem is exactly where we started to think. We noticed 2 problems with the GameStop story. The first was a really evident problem, which is that everybody coordinated on a social media platform called Reddit, and they're anonymous to each other. And there was no way to verify that people who were participating in the conversation were actually shareholders of that company. And so as a result, there was a bit of a trust problem. And the second, I think, is not so much related to GameStop itself, but the question is, okay, you coordinated, you figured out, you bought shares, you got somebody on the board, and then what? That platform, that experience, that moment can and should happen again. And so the idea was, what if we were to systematically do this? What other side of the market might be interested in this effort? And it turns out that activist investing hedge funds more and more are going to need support of the general public, which is increasingly present and buying shares. And so we figured if we can coordinate and kind of link up 2 sides of the market, a very active and engaged but very distributed retail shareholder population, along with the population of activist hedge funds that are fighting the good fight, it might be interesting. And so Troop was kind of born out of that idea of connecting these 2 sides and solving the anonymity problem.
It's very rare to see a company that both speaks the language of Twitch streamers, TikTokers, and Redditors, but also spend a fair amount of time talking to activist impact investors or proxy solicitation companies. I feel like those 2 have never heard of each other, generally speaking. And side note, if you are curious about the world of crypto and DAOs, that is a whole other thing. But in that world, they do speak. And so in sort of the equities world, what is Troop's unique angle in bringing this kind of cultural voice into something that is driving a ton of impact, but most consumers don't know about?
That's a great question. So it's funny you bring up DAOs and the world of crypto and like distributed technology. What we are observing in that world is fundraising done by individuals in a distributed way at the speed of light. And we saw this in a few different instances. And so kind of leaning on the energy and the excitement from that area, but then also trying to open up a conversation with the more professional side of activism and the professional side of investing, people who are accredited, who are institutional, enables us to try and lend credibility to both sides. Right? You have one side that's focused mostly, or tends to be focused on kind of short-term returns, kind of at the expense of a longer-term focus. They need to hear from the more energetic, but perhaps not distributed super wealthy side that compromises need to be found. And actually, both sides need each other to kind of amplify the message. And that's sort of where we see the bridge between these 2 sides, basically.
And how do you actually, talk to a Twitch streamer's audience, or how do you tap into the Reddit sentiment about a certain company?
That's a great question. I think the first thing is to figure out, in a consumer-facing company, where is their retail shareholder population, where are their customers, and is there any overlap? And especially in more modern, more tech-heavy companies, we're seeing a lot of overlap between these 2 populations. An interesting example of recent note, which took place over the course of December and January, December of last year, January of this year, was Blizzard Activision, which was the target of pretty aggressive shareholder activism and then eventually got bought out by Microsoft, what we saw was, at least as far as Troop is concerned, an ability to gather a lot of interest and attention from units of gamers, people who spend a lot of their time online, who have enough disposable income to buy 1, 2, or 3 shares. And we're very quick to rally to the idea. The idea kind of concluded fairly quickly after Microsoft came in and bought out Activision Blizzard. But we saw right then and there the possibility of kind of building a bit of excitement in a crowd in the community that's already native to these platforms.
And that's a muscle most people in that industry don't have. And that's a uniquely, I guess, tech consumer-led muscle that only a lot of tech startups have started to build, but usually selling things like Instagram clicks and e-commerce products. So when you talk to these retail activists, maybe not even investors yet, but just retail interested folks, what do they tell you, and how much do they know about activism agendas, and how do they feel about being able to contribute to those?
Good question. So after we, along with my 2 co-founders, got inspired by the GameStop episode, we imagined a productized version of this. We drew up some sketches, and then we went to dog parks, bars, restaurants, parks, all over in New York City and Brooklyn, and just asked people, "Do you own stocks?" And most people said, "Yeah, 1 or 2, or I think my friends do." And then we asked them, like, "Do you vote your stocks?" And the overwhelming majority of people asked us, "What are you talking about?" And those who did know what we were talking about certainly did not vote their stocks. And so we figured maybe there's an opportunity to turn this unused asset into something that you can kind of benefit from. And so the idea there was to look for a side of the market that might have an interest and see value in these unused, kind of votable but untouched voting assets, right? So shareholder voting rights, and that's mostly where we decided to focus first. We learned also that the experience overall for those who do know what it is and who do vote, the user experience and the user interface just leaves a lot to be desired, and it's an industry, quite frankly, that hasn't really changed since the 1970s and is due for a bit of an overhaul. Now, there are 1 or 2 companies that are doing the good work in this space. Our objective is to try and link up with them as soon as we can and make this a more collaborative effort for the benefit of everybody investing, whether you have 1 share or 1 million shares.
And I guess the bet is that if you can tap into someone's enthusiasm about a brand to get them to buy a mattress or to buy a pair of glasses on Instagram ads, you might be able to activate their interest in an agenda to vote, a share of stock. And that's a leap of faith that I think most folks haven't tried to test yet, which is pretty exciting.
It is, yeah. There's one. So it's actually reminiscent of a good story from last year. So some of you may have heard of a hedge fund called Engine Number 1, and Engine Number 1 pulled off a very historic win last year, snatching 3 board seats at ExxonMobil, which is one of the biggest oil and gas companies in the world. Now, if your number 1 focus and your number 1 center of attention on activism is solving the climate crisis, there are many ways to go about doing that. But I really can't think of one that has perhaps a more overarching and a more direct impact than swapping out the board of the biggest oil and gas company in the world, right? And with a specific mandate to transition the company to renewable energies. Now, is that going to happen on the short term? Probably not. But if your number 1 metric is impact, you have to go to the source. And Engine Number 1 was extremely inspiring to us, what they were able to do. And we figured if we can advertise this story and we can get people to read about it and to look into it, might that inspire them to direct their attention and towards shareholder activism as perhaps the greatest vector for impact that you could possibly have?
That's an amazing story. Truly, the little guys taking on the big ones and winning. To switch gears a little bit, let's talk about this question between impact and profit, or purpose and profit. I think I've asked this to the other panelists. in different ways, but I'll ask it to you here as well. And for the record, North Zone invested in Troop without having a strictly impact metric that we had to hit. It was for profit. But as you think about this trade-off more broadly in kind of the equities world, I know you have a really unique view on it, so I'll just let you take it from here.
Sure thing. So, I mean, first and foremost, as my board member, Wendy, you should know we're definitely working on the profit piece. We're going to get there. We're going to figure it out. So I will say this. If you go back to the origin story, at least in the United States, the legal story, the history of the incorporation, you used to have to go and advocate for a license to do business. And you used to have to demonstrate what purpose you were going to serve above and beyond just turning a profit. In other words, there had to be a bit of a purpose, a bit of an idea, something that you were contributing to society and to a lesser extent, perhaps at the time, the environment. And we've come a long ways away from that, but that was relatively untouched until towards the end of the 1960s. If you look at Harvard Business Review, year after year, they had sentiment analysis put out where they would interview CEOs about what their mission was and what their objective was. And up until 1969, the overwhelming majority of CEOs in America found that the purpose of their company was well and beyond just turning a profit. Now, enter the 1970s with Milton Friedman-led Chicago-style and Stanford-style economics. It kind of changed the game away from profit and purpose combined and really splitting them in half and focusing mostly on number one thing, which is the primacy of returning value to your shareholders on the shortest term possible. And that obsessive pursuit of short-term profit at the expense of everything else kind of got us to where we are today, where we're asking ourselves whether, well, you know, should I invest in this company or this company? This company makes more money, but this company does a little bit less, but also doesn't destroy the environment. Well, you know what? They have a better return. I think within our lifetime, I think we all hope to see the disappearance of that kind of mentality. In the future, we'll look back and wonder what were we thinking. And so the idea there is to kind of lean in a little bit to finding more creative ways to marry two sides of the business. At the end of the day, though, we are talking about generating revenue. We do have margins to protect. And as far as Troop is concerned, to be totally transparent, our objective is to kind of lean into the funds, whether they're institutional, hedge, pension, you name it, that are looking for support from the retail population and who are willing to proverbially put their hand to their pocket to solicit proxy votes. We are intending to operate as an intermediary, as a marketing and advertising branch and an engineering division behind it as well, building out a product that connects a distributed group of retail shareholders to the overall market of activism and just people who want to help, through their dollars, try and steer us back collectively to a more sensible economy.
And that touches a little bit on what we talked about earlier at a very high level around capturing externalities in markets. You're enabling folks to be able to together show meaningful ways to capture externalities and to vote on those agenda items to allow companies to more correctly capture externalities. And it's interesting because I guess more people are going to be affected by externalities than just the shareholders themselves. And so can you identify, and you know, for the non-econ nerds in here, brief explanation, externalities, it's the value generated, positive or negative, by an economic transaction in a market that is not captured in that transaction, right? It's not showing up in the returns. So can you give an example of an externality, and whether it's, you know, Exxon or some of the other ones, that have really affected consumers at mass that they would be potentially excited about voting on and rallying behind at sort of the shareholder level in order to affect change?
Sure thing. There's one example in particular that comes to mind. I stumbled upon it when I was doing my research quite a while ago. Right after the housing crisis of 06-08, in a quiet corner of the financial world was an impact activist investor based out of Seattle that decided to focus on McDonald's. Now, McDonald's at the time, I don't know if it's still the case today, but at the time was in the top 3 biggest growers of potatoes in the US. And they were using a fairly insane amount of pesticides. And what this tiny fund in Seattle decided to do was to introduce a measure at the annual shareholder meeting of McDonald's and suggest perhaps using slightly less pesticides and instead focusing on the balance sheet improvements that might result out of that. They ran a pilot and quickly and saw really interesting results, expanded that to the majority of their crops. Some of the externalities that came out of that were, in addition to McDonald's stock going up and customers reporting greater rates of satisfaction with French fries, to speak tangibly, what we also saw was species of fauna and flora return to the environments where McDonald's was practicing previously very intense farming at really, really interesting rates. And it ended up being the proverbial win-win-win. I'm probably missing 1 or 2 other wins, but basically it was a fairly well-distributed win. And if that is possible, and it's possible to engage people and teach them about it and get participation, we should be able to do that at scale with almost every company that's publicly traded.
That's a great vision indeed.
Thank you.
Thank you so much. And that concludes our section for today. Thank you for sticking around. And I hope you stick around for the future ones on this stage. Thanks, everyone.
Thank you.